This week's update is the rally over, where to now, and status update for precious metals. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. Let's just have a look at the overall perspective because it was quite a roller coaster ride in the end of the week. So let's have a look first of all at what drove prices up from the March lows, because it really has been an incredible rally on the S&P, 35% down in February and early March, and then a 45% rebound since the lows of March. There were several things. There was the optimism that we would get a V-shaped recovery, that the lockdown would be shorter than what was originally thought, and that economies would be less affected. Whether that turns out to be true or not remains to be seen. Secondly, there was an incredible level of liquidity thanks to central banks. And thirdly, there's the ETF process that I've been talking about for years, and that's the fact that it's ETFs as a passive investment avenue has grown to such a degree that it has a serious impact on markets. And basically you get a self-propelling move in the upwards direction, and that's pretty much all we've seen for the last 5 or 10 years. It's been interrupted a few times briefly where selling caused a reversal of that ETF trend, but it's basically there's not a valuation determination happening here. The prices of stocks are going up, and so ETFs on a passive basis without any thought to the value of those stocks just buy more stocks, and that causes stocks to go up, which causes more ETF buying, and so on and so on. It's just an upward spiral, and no one really knows if we get into a serious reversal that's extended, let's say for 12 months or more, how that is all going to work, because a lot of these ETFs are not very liquid. So that's always been the overhang over the market. But in the period from March, certainly that ETF process to the upside worked in a positive direction. So the question is now, where to from here? Has the index rally ended? Well, look, in the short term, as you know, I'm always driven by the price action more than necessarily a logical examination of the market, because we just find these days that markets are doing things that are completely illogical. But taking a line through the price action that we saw and the abrupt change on Thursday, I have to conclude that in the short term, at the index level, the rally probably has finished. Medium to longer term, probably not, and I've been showing that chart for a couple of weeks. I believe we're in a secular bull market that started in 2013, and I'll show you that chart again today just to recap on that. So medium to longer term, no, I don't believe the index rally has finished, and I believe that there's every chance in the US that we could get a new index high by the end of the year. Maybe we will, maybe we don't. I don't really care because I don't trade the index, I trade individual stocks. And so that then brings me to the third area, and that is the key groups that have got unquestionable tailwinds for earnings growth for as far as the eye can see. And has the rally for them ended? Absolutely not. In fact, the situation in some respects is even more enticing. You look at a company like Zoom Communications. Their business has just gone absolutely through the roof because of what has happened. And there are other businesses that are in a similar position. So not everybody has been on the losing end of this global lockdown. And so rather than try to invest in the general market, just pick the stocks that are going to do well. It's not a difficult formula. Okay, so let's have a look at what happened on Thursday. So everything was going along very nicely. We were sitting at double tops more than a week ago, and then the market broke out early in the week, and everything looked just extraordinarily positive. But what happened with the Fed meeting is that we've got a very overbought market and extreme optimism, and that ran smack bang into the reality that the Fed painted, and that is the economy is not in good shape, and it's going to stay down for quite a long period of time. Now, that reality was always there for anyone that stopped to think about it, but the market had just been ignoring it. Now, the fact that the Fed put it into words, plus there was also a spike in virus cases in probably half a dozen US states, and that was just enough to really tip it over the edge, and the indices were down 5, 6, 7% in the day, and the selling just went on and on and on throughout the session. And this is probably where the ETFs and the computer algorithms were really exacerbating the situation. Now, some people are fearful of inflation. People have been talking about inflation with all this massive stimulus since 2011, 2012, but it hasn't happened. Now, it's coming up again, and the stimulus now is so extreme from central banks that you can understand that the inflation argument is coming up again, because it's sort of logical. But when you actually look behind what happens to cause inflation, it's actually not very likely still. So money supply, so that the amount of money that the Fed is pumping and other central banks are pumping into the world's global financial system, has absolutely exploded. Everybody knows that. But the other key ingredient is money velocity, and that's actually gone down, and I'll show you a chart of that in just a minute. The end result is that whilst there is an incredible injection of money into the system, banks are not lending. They're being cautious about lending. There's also not the demand. People aren't borrowing. So the net result is that money is not being lent out, and the money is really just building up on banks' balance sheets. Just to explain what money velocity is, it's the number of times a dollar is spent per unit of time. So how many transactions in the economy are occurring within a given period of time. And the faster that money is turning over, the more that it impacts inflation. Now, that's not happening at the moment, as you'll see very, very starkly. The velocity is still dropping and has been dropping for several decades. Plus, on top of that, we are now certainly going to have much higher unemployment for a lengthy period of time, perhaps 3-4 years. And there is excess capacity now in the system, excess manufacturing capacity, excess services capacity. So they're the things that create inflation. So when you really understand what inflation is about, you can understand why it hasn't moved in the last 8-9 years, and why, despite this incredible stimulus, it's probably quite possible that inflation is not really going to kick up yet. Here's the chart. As you can see now, the blue line is the amount of money being injected. It's called the M2 money supply. It's the amount of money being injected into the system. And you can see that just recently, it's absolutely gone through the roof. So this is a 60-year chart. So this is pretty big picture stuff. And you can see it has just absolutely exploded. Yet the yellow line is money velocity. And you can see money velocity increased up until the 1990s. And you remember during that period, we had a real inflation problem. Inflation was running at extremely high levels. And then basically since then, the money velocity, so how often money is turning over in the economy, has been on a long-term decline. And you can see just recently that money velocity is still dropping. So that is why inflation is probably not going to appear as many people expect it to. Okay, let's take a look at, there's just one other thing. I'll come to that in a minute. Let's look at, the S&P was down 4.8% for the week. And what bothers me about Thursday is that it was such an abrupt change. And trends tend to change with very, very sharp moves. We saw that in late February, and we've seen the VIX spike up enormously, and it can't be ignored. Now, as you know, I'm guided by the price action. I don't try and second guess where the market might go or predict where the market might go. I just follow the signals and go with what the market is telling me. And the moves in the VIX and equities on Thursday is sufficiently concerning that I think you need to take note of it and take some action. More on that as we go through the video. Let me just show you, here's the chart for the VIX. So this is looking back over the last 6 months. So the VIX index typically sits somewhere between 10 and 16 or 17, typically. Now you can see in the 21st of February, you can see the VIX started to take off, and it absolutely rocketed up until the middle of March, hit a high of 82, which was the second highest reading on record, only just shy of where it got to in the GFC. And then we fell all the way back again, but we didn't go back all the way down to the normal sort of levels. We held between 25 and 30 since early May. But look at the spike, and this is on a closing basis. On an intraday basis, the index, the VIX index actually went up into the mid to high 40s intraday. So we've had a huge spike in the VIX, and anything over 30, you've really got to be a bit concerned about equities when the VIX spikes up over 30. So we went up into the mid 40s, we've pulled back to the mid 30s, but that plus the price action on the S&P is enough for me to do something about it, at least in the short term. Okay, so there was quite significant technical damage was done on Thursday. We've got a backdrop of economic, social and geopolitical upheaval. I won't list them out. The list is as long as your arm. And you could be forgiven for thinking that that it's really all doom and gloom ahead because things are so bad. But look, we've had issues constantly for the last 10, 20 years, and markets have continued to go up quite strongly. And then we've got some other absurd stuff which really clouds the future. And in Minneapolis is one example, but it's not the only place. There is the likelihood that there will be a vote to disband the police force, if you could believe that. And as a consequence, gun sales are soaring. You know, we're in a very, very fluid situation. And hence, I think we're entitled to respond more readily to what the market is telling us. Now, the US dollar did recover a bit, so we dipped quite sharply, but then we recovered to finish around 97.5. The 10-year yield fell again. It got up to about 1.2%, but fell again very sharply down to 0.7. So let's take a look at some charts. We'll start first of all with the S&P, big picture, monthly chart. This is the peak in 2000. This is the peak in 2008. My argument is that this was a secular bear market, which had cyclical bears and bulls within it. And then we broke out in 2013 into a new secular bull market, which at this point in time is still in progress. Now, it is possible that this could be the end, but it's not really long enough. Secular bull markets tend to run more like 15 to 20 years. This one's only been running for 7. So if this were to be the end of a secular bull market, it would be an incredibly short one. So, you know, I think we're still within that. Now, we've had a couple of sharp cyclical bear markets. We got one at the end of 2018 that only lasted 3 months. And we've just had another one that lasted 1 month. I mean, it's quite extraordinary, but it qualifies as a cyclical bear market. So that's the big picture. Now let's look at the technical damage that happened. So the market ran up to some resistance, which was the highs of March, paused for a day, and then not only broke through that resistance, but actually gapped through it. This was a very powerful breakout, and that was largely around the May jobs report. Now, it managed to go up for another day or so, And then, of course, with the Fed statement and the reality of the Fed statement, we got this huge gap down, massive candle, close right on the lows. That's done a lot of technical damage in terms of breaking likely support levels. You can't ignore a session like that. So I think the probability in the short term, not the guarantee, that's not a prediction, it's just the probability. When you get a move like this, it generally leads to more downside. Now, whether it'll be like this again, I think that's extremely unlikely. If you look at history, you just don't get back-to-back crashes. So I don't think we're going to see an event like we saw in March. But I don't know where this is going to go in the short term. And as a consequence, it's significant enough to take some action. So I think that's warranted. Let's look at quickly at the US dollar. So we dipped all the way to support and found support pretty much where you'd expect to find it, and the US dollar turned back up again. Now, the impact for the Aussie dollar, we also ran up to resistance, which was the peaks from April 2019, July 2019, and December 2019. And now we've turned back down from there. So we've had a little run above the 200-day moving average. I suspect, looking at the strength in iron ore, that we're probably going to trade somewhere between 65 and 70. Seems to sort of make sense to me, but I'm by no means a currency expert. So I think that's likely where the Aussie dollar is going to fluctuate. Okay, let's turn to Aussie stocks. So our dollar is back to 68.5. Our index dropped 1% on the week. Now, whether we see some more selling, because the US did go higher on Friday night, so it's probably a bit unclear as to how our market might open on Monday. But it's pretty clear once again on Thursday, because the big selling in Australia occurred on Thursday before the US fell apart. And so once again, it just shows that global funds are using our market to front run other markets around the world. So because our market is the first major market to open, then funds that are invested in Europe and America effectively use our market to hedge their exposure before their markets actually open. When we're seeing it just more and more and more these days. I think it's still really important, and I make this point very, very regularly, do not view our market through the lens of the index. If you're making your decisions around what the media is feeding you about the index, then you're being thrown completely off track. We've got an incredibly bifurcated market where some stocks are doing really, really well and other stocks are doing really poorly. Just focus on the stocks that are doing really well and where the high probability is that they'll continue to do really well. If you think and react to our market around the index, then you're definitely on the wrong track. We've seen a bounce in energy and financials and a number of the areas that were very beaten down for good reason. Property trusts and things of that nature. So we've had a bit of a dead cat bounce in those sectors that are definitely affected economically. It's probably ended. It was largely built on the grounds of a short squeeze, short sellers taking their profit, and so it was never going to be sustainable, and always very risky to try and trade those sort of markets because you just don't know when they're going to end. And when they end, that turnaround can be quite savage. Okay, so let's just look at the Aussie index. So there's the ASX 200. We managed to get up to just over 6,000 points, but we've pulled back again from that. If we look at the economically affected sectors, we had quite a bounce in energy that was lagging, and then you can see how quickly that gave away. Banks, similarly, this was a real short squeeze stuff. and we saw the excess come back out of that. Healthcare has remained extremely resilient through the whole process, and that's the point that I'm making. Don't trade the index, trade the strongest sectors of the market. Okay, let's look at precious metals. So just a little bit of background, first of all. The major gold demand, and it has always been the case, is from jewellery. Jewellery demand is normally fairly static. It's normally around 50% of total demand for gold. So you've got jewellery, you've got investment demand, you've got central bank buying, you've got speculators in the futures market, and it's really jewellery that is it's pretty steady and it's there pretty much all the time, and it's the biggest demand. And the demand for investment purposes, if you look over the last 5 years, the average is around about 20%, 27% of total. Now, it does fluctuate quite a bit depending on how people see the gold market. What we've seen in very recent, this year, and particularly the last couple of months, is that we've got weak jewellery demand, weaker than normal. But that's been offset by abnormally strong investment demand. So investment demand has really kicked up. And this is important because it's investment demand that sustains a trend in the gold price. Speculators don't do it. The jewellery demand is pretty static, so that doesn't do it. It's the investment demand that is really the contributor to where the gold price goes. And it is incredibly strong at the moment. And why not? Because we've got this situation where funds around the world are just disastrously underweight gold. They're probably 1/10 of what they should be. And so we're seeing this progressive ongoing shift of capital from just a stupidly underweight position in precious metals to something larger. We've got a long, long way to go. This will probably run for years as this readjustment takes place, as more and more people start to understand that they just need more gold in their portfolio to hedge all the uncertainties that are there. So there is definitely that shift going on. I pulled up the actual holdings in GLD. So the GLD is the ETF that tracks the gold price. So if you buy shares in the GLD ETF, then the fund manager takes that money and goes out and buys allocated gold, and they actually physically store it. So it's real. It's backed ounce for ounce by gold. And so it was interesting to go back and look at the spreadsheet that shows the holdings in GLD over time. Now, the gold price reached an all-time high of $1,900 back in September of 2011. So that was the all-time high. And at that time, obviously, a lot of people had bought into GLD, and therefore the total holdings were 42 million ounces of gold were in GLD. Now, the gold price peaked and it fell then for 7 years. So in January of 2016, the GLD holdings had actually fallen from 42 million ounces to 20 million ounces, and that was the low point in the start of 2016. Now, by October 2018, it had moved up a little bit, but not a great deal. We were at 24 million ounces. Now, rolling on to January 2020, the start of this year, again, we'd moved up a degree, but not a lot, considering how much the gold price has gone up in the last 12 months since the middle of 2019. So we'd moved up to 28 million ounces. But look at where we are now, and particularly in most of this has happened in the last 3 months, is that holdings have just absolutely exploded. And the holdings now sit at 37 million ounces. So the fact that there is rising gold investment demand is not just based on someone's assumption or perception. This is the most quantifiable, factual way that you can determine whether money is flowing into gold or not. It's through this GLD Holdings. So there's no question that investment demand for gold is soaring, and it's investment demand that will sustain the trend. So that's why I remain very positive about precious metals. Now, gold rose $46, which was almost exactly what it lost the prior week, and finished at $17.32. I'd also add that GLD holdings are soaring at the moment, despite the fact that this is the weakest demand period of the year. This is a real seasonal lull in traditional buying. So, it's pretty impressive at the moment. The key price drivers for gold, the ones that impact positively are low or zero or negative real interest rates, and we've got that. The second one is fear, and we have that to a degree. It varies, it goes up and down, but I think we're going to have fear revisiting quite regularly, particularly in the lead up to the US election, because there's going to be all sorts of outrageous things said and done. The next positive is inflation. Well, that's probably one that's not going to come into play for the reasons that I outlined before. And then the other positive, of course, is a shift in portfolio weighting, which would certainly appear to be underway and is certainly warranted. So there's a lot of positive price drivers. And then we've got the currency, which obviously is either a positive or a negative, depending on what the currency's doing. And frankly, from here, I find it extremely difficult to have an opinion about where the US dollar is going to go. It's just too unpredictable. So at the moment, almost all the drivers are positive for the gold price, which is the key thing. Now, if we look at precious metal stocks, GDX broke out in April. We're now getting a retest. So let's look at that. So we'll start first of all with we'll look at gold on a weekly chart. So we're still in the channel. This has been, I haven't moved these trend lines now for quite a long period of time, and we're still in this very steep upward sloping channel. We're sitting around about the midpoint. No reason why it can't continue to head up in this direction, and at the current rate of ascent, we would reach 1900. That's not saying it'll happen, but we would reach 1900 by around about February next year. So that's the sort of rate of increase that we are tracking at the moment. Now, if you look at the daily, you can see we had a dip last week, but then recovered it all in the week just gone. And silver has definitely rebounded after an absolute smashing during the crash. GDX is on a weekly chart. Huge base that started forming in 2013. We broke out in the middle to latter half of April. We've now retested. Gold stocks were impacted Thursday because in a market sell-off, gold stocks are still stocks, and in the short term they still go down. But what happens with gold stocks? Some people think that if you own gold stocks and the market goes down, then gold stocks will go up. Not in the short term. In the short term, gold stocks will go down with everything else because there's just panic selling. But gold stocks will go down less, and they'll come back quicker than most other sections of the market. And so I would expect that to happen again. So the odds remain very favourable for precious metals. Turning to other commodities, copper up again. The futures market getting back to normal there. Crude oil has had a heck of a run, but still a sector in a lot of trouble with overproduction and compared to demand. So it dropped back about $1.50. US production is still falling. It's the lowest level in nearly 2 years, but inventories are still going up because demand is just not there. And energy stocks were one of the dead cat bounce sectors, and they're starting to turn down sharply again now. There's the spot copper chart. So wrapping it up, actions to consider. The first thing is you need to resist the urge to respond to the day-to-day price movements. up or down, because there's going to be a lot of abrupt movements. The one on Thursday was well beyond that, and it's likely that it could signal a short-term trend change. And so therefore, I think you're entitled to respond to what we saw on Thursday and the spike in the VIX. So I would be looking at raising cash levels, reducing exposure. And that does two things. If you reduce exposure, then you've got less stocks that are subject to any decline that might occur. And look, the decline may not occur. We may have seen it all on Thursday. I don't know. I'm just playing the odds here. That's all you can do. So reducing exposure reduces the amount of stocks that you've got that could be subject to a decline. And then, of course, you've got more cash to use at the bottom to pick up the rebounds. And there is no question about the fact that there will be rebounds in some sectors. The other thing that you should do is just get rid of lower quality stocks without really strong balance sheets and cash flows and earnings, strong future earnings outlook. Just get rid of them. Whether they're in profit or loss is not relevant, because the chances are the prices are not going to recover and they're probably going to go lower. So just get rid of low quality stocks. And if you've got overweight positions in the stocks that you're holding for the long term, and there's some just outstanding stocks that you want to own for the long term, but they've become very large. You know, some of the stocks in our membership portfolios have gone up 300%, 400%, 500% since the lows in March. So if they've become extremely large in your portfolio, then you might want to trim those exposures back and take some profit off the table. The most important thing here is that capital preservation is the absolute paramount thing that you should be considering. If I'm wrong in suggesting that you lower your exposure, then the worst thing that can happen is you're going to miss out on a bit of profit. But that is far preferable than being overexposed if the market does go down. So think capital preservation before you think about profits. Portfolio this week is really just a matter of looking at the various sectors and resetting any short-term strategy as required. But by the time I record Portfolio Analyst on Wednesday, we would have had another 2 sessions in America, and a lot can change in 2 sessions. So it'll be whatever is appropriate. I'll be following the market. I'm guided by the price action, and just focusing on the sectors that are highly likely to do best. That's it for this week. So if you want to find out more, there is plenty of information on the website. There's my email address, and I'll be back with you next week. Cheers.